Hey everyone, thank you for tuning in. Going to look at the markets, but I want to talk about my headline here, whatever the hell you want to call it, about Trump and Grover Cleveland and the Ecclesiastes. I mean, I'm not promoting Christianity, or I mean, actually, I would promote Christianity because it's a very good religion compared to a bunch of the other ones. But if you want to look at a chart and you want to understand it, you have to understand that we are looking at a graphical illustration of human nature. Okay. Since Grover Cleveland was in office in the late 1870s and the early 1880s, the names have changed, the people have changed, the company has changed, the technology has changed. You know what hasn't changed? Human nature. People back then felt buyer's remorse. People back then felt seller's remorse, just like today. So I want to show you, I'm going to pick a random chart. I don't know. How about Apple? AAPL. Let's take a look at Apple. And let me just show you something here. All right. So check this out. See how in Apple there was support, I don't know, around 168 back in October and September. And guess what? It became support again. All right. Why? Well, there's people who sold at the bottom when it was support, and then the market rallies, and they're like, "Ah, I made a stupid mistake. I'm going to buy my shares back if I can get them at the same price I sold them at." So remorseful buyers placing sell orders at a level that was support can make it support again. Why do we have resistance right up around here? I don't know, 196, 197. Why is there resistance at a resistance level? That was resistance before. Or let me say that again. It is Saturday night, everybody. I have been at the 19th hole. But why is there resistance at a level that was resistance before? Well, this is buyer's remorse. It's the opposite of seller's remorse. People bought, price goes down. They're like, "Ah, I made a mistake. I'm losing money. If I can ever get out at break even, I'm going to." So when it gets back to that price level, they go to sell. Remorseful buyers placing sell orders at the level that was resistance can keep it intact. We see a couple other things on this chart here. Notice how resistance converted into support, and notice how support converted into resistance. This is also because of seller's remorse. People sell here, excuse me, they think they made the right decision and the price eventually goes higher. And they're like, I made a mistake. If I could buy my shares back, I will. So remorseful sellers placing buy orders at the same price they sold at can form support at the level that was resistance. Here we have the opposite. What was support can convert into resistance. So here resistance converts into support. Here support converts into resistance. This is buyer's remorse down here. People bought here, the price goes lower. They're like, damn, I made a mistake. And if it ever gets to my level, I'm going to get out break even if I can. So remorseful buyers placing sell orders at the level that was support convert support into resistance. Remorseful sellers placing buy orders at the level that was resistance converts resistance into support. Remorseful buyers placing sell orders at the level that was a top before can keep resistance intact. Remorseful sellers who want to buy their shares back can keep support intact. Why is this important? Okay, here we go. Let's go back to a chart from when Grover Cleveland was president. Okay. Now, the names have changed, the company has changed, the technology has changed. I mean, they didn't even have cars back there. They didn't even have electricity. They didn't have planes. But what happens? I mean, look at this. To me, this is amazing. This is the S&P from, I don't know, 1870 something until 1913. Resistance becomes resistance. Resistance converts into support. Support converts into resistance. Support stays intact. Resistance stays intact. Okay, what was support becomes support again. I didn't even address market memory. I mean, check this out. When the market crashed and finally found a bottom in 32, it was support at the same level that was in 1897, 1893. So if you want to understand a chart, you have to look at it through the prism of psychology. Forget all this dumbass stuff like, oh, Gann theory, oh, Elliott wave, oh, Fibonacci. Real traders in the institutional world don't even use that stuff. I never even knew what it was until I basically retired and decided to teach retail people. All right. So anyway, blah, 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 blah. The reason why I put Trump on there is because there's a really good chance he's going to win the election again. Back in the 1800s, Grover Cleveland was the president. He lost the election. People didn't like the next president, Harrison, so they put him back in office. History could repeat itself. All right, so real quick, let's just look at the markets here. I just want to show you what I'm going to be watching this week. We've had some pretty negative action. This is what we call the old bearish engulfing pattern or reversal day. Notice how, like, we opened here, we closed here. This shows there are aggressive sellers out there. If I'm looking for a short-term bottom, what did we just see? Resistance becomes support because of seller's remorse. Resistance here, there's a good chance there's going to be support here. So this is about 523 or so, maybe 6 points lower. So if you're a short-term trader, and I know we have a lot of those here as our students, and I appreciate it, a lot of day traders, that's where I'd be looking for the bounce. Maybe around 523, 524. We can't be too precise. All right. So let's just look at a couple of these sectors here, because there are things that are making me think that, yeah, we get down here and we bounce, but we eventually break down and go lower. Why? Let's look at the sectors. The S&P is 11 sectors. Some of them are really small: real estate, utilities, materials. They're not going to affect the broader market, but you got to know what's going on with tech. You got to know what's going on in healthcare. You got to know what's going on with financials. You got to know what's going on with industrials. So let's look at tech. Same kind of a thing, massive bearish engulfing pattern. Just looking back, if we could see the same pattern. All right, it kind of happened here. See, it's called an engulfing pattern because it engulfs the prior day's trading. This is a really textbook one here. Check this out. So in the morning, you would have been like, it's going to be another up day. By the close, the sellers pushed all the way back. See, here's the thing about reversal patterns. When we want to look at a reversal pattern, this is what we want to look for. All right. When the leadership is changing from bears to bulls or bulls to bears, the dynamics can show up on a chart as something that looks like a reversal pattern. If it takes place over kind of an extended time period, it's slow, might be a rounded top or bottom. If it takes place over a couple time periods, it could be the old V or inverted V formation. If we get the reversal in a day, really quick reversal, could show up as what we call one of these bearish engulfing patterns. It's a one-day reversal. So that's tech. Probably going to be some support around about 210. But one of the things that really kind of makes me bearish is right here. This is our healthcare sector, the biggest sector in the market. Here's our psychology again: resistance, resistance, support, support, support becomes resistance, blah, 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 resistance becomes support. The support here is broken. The uptrend is broken. Looks like healthcare is about to head lower. The financials, got to a former resistance level. A lot of times things sell off of former resistance levels. Why? What is resistance? It's a large group of sellers. You get to a resistance level in a market, some of these sellers start to look around and think like, oh man, other sellers are coming in here. I better be more aggressive if I want to get out of this. They start to undercut each other. You get this snowball effect. Oh, there's a bearish engulfing pattern right there. Okay. So, stock market jobber, this is what we do. We look at patterns, we follow the markets, we help students learn how to make money. And we have students that are very beginners, and I also have institutions that I consult for with people that you might think are impressive, people that are seasoned veterans, and you might think like, oh, this guy's a veteran, blah, blah, blah. Let me tell you something. They need to learn too. All right. So last thing I want to show here before I let you all enjoy your Saturday night on the long weekend. This is the bond market, okay? The bond ETF. Remember, if bonds go down, interest rates go up, and that's bad for markets. This is an instance where what was support converted into resistance because of buyer's remorse. If the sellers start undercutting each other here, that's going to drive interest rates higher, and that's going to be bearish for markets. Just one more thing before I go here. I just want to point out this classic descending triangle pattern. Ascending and descending triangle patterns are pretty reliable if you understand what they are. So the descending triangle pattern is an illustration of aggressive sellers and complacent buyers or patient buyers. You can tell that. The support level stays the same. The valleys form at the same prices. That means the buyers are hanging out. We'll buy if we get to the same price. But the peaks or the highs are forming at lower levels. We call this lower highs. So supply stays intact, but the sellers are becoming more and more aggressive. Think about it. Complacent buyers, aggressive sellers. I don't care what market it is. That's going to set the stage for a move lower most of the time. Not all the time, but these patterns tend to be pretty reliable. All right, everybody. I hope that helps, and I will see you soon. Thanks. Have a good week.